In payroll tax, large volumes of data are processed under highly regulated and tight deadlines. Missing deadlines or filing and paying inaccurate taxes can result in steep consequences, including large penalties and sometimes even imprisonment. Despite many companies' best efforts at compliance, there is one gap that continues to be a perpetual thorn in the side. The complexities of multi-state taxation have proven to be a challenge, even for the most seasoned payroll tax professionals. In most situations, state withholding tax is owed to the state in which the associated wages were earned. This is not so complex when an employee lives and works all in one state and never deviates. However, this perfect scenario is becoming less and less the norm. The volume of business travel in the U.S. is increasing each year. These business trips create significant tax liability, as they usually involve employees crossing jurisdictional borders to conduct work. Uniformity does not exist in payroll tax. Each state has their own laws, which employers are required to follow, and the laws within a state may not be uniform to all business travelers. A business traveler coming from one state may be treated differently than a business traveler coming from another state, based on the reciprocal agreements between each of the states. Adding even more complexity to the issue, some states require employees to submit tax forms to their employers before the reciprocity agreement applies to them. Many states have adopted de minimis standards, which allow employers to send employees to work in the state without having an immediate tax obligation. De minimis standards also vary from one state to another. Some state standards are based on days worked in the state, others on dollar amounts earned in the state, and some are based on a combination of days worked and dollars earned. Still others require immediate liability. In some cases, de minimis laws exempt employers from withholding and paying tax to the state, but it doesn't extend to the employee. The wages are still considered taxable, and the employee is responsible for paying any resulting liability when they file their personal income tax return. Each new business trip could create a new tax liability. Tracking state de minimis standards, reciprocal agreements, and employees' movement from one jurisdiction to another, and keeping it up to date each and every pay period has proven to be problematic. This daunting task has created an environment where many employers have chosen to look the other way, rather than attempting compliance, as withholding audits were rare and the risks seemed small. In recent years, with the advancement of technology, red flags have become more apparent, and non-resident income tax withholding audits have become a great source of revenue for taxing authorities. In addition to the increased tax liability, employers may find themselves having to pay penalties and interest. Employees are also at increased risk of being audited and assessed penalties, interest, and taxes. Officers can be found personally liable, and criminal charges can even be made. In recent years, auditors have been asking to examine expense reports, calendars, and travel itineraries to determine when taxable wages have not been reported properly. These documents have been used to assert that the employer had knowledge of the employee's work location and neglected to fulfill their responsibilities to report and pay the appropriate taxes. Typically, human resource professionals, recruiters, and managers are entering information into a human resource information system in which payroll is processed and payroll taxes are calculated. This process is flawed because the associates making the changes in the system are not familiar with the tax laws that are so complex that they challenge payroll professionals. Inaccurate data is often entered into the system. Data such as a work location that is actually the location that the employee is reporting to, but not the location where the employee is physically working. This is common with telecommuters and mobile employees who travel for work. In these situations, an employee may be set up with data that looks plausible, which is a problem because now it won't be picked up by an audit, and the output is only as good as the input. Currently, the only real solution is to pay for high-priced employment tax attorneys or tax consultants, which can charge hundreds of dollars per hour. This isn't realistic for the average business, especially when considering the amount of time it would take to maintain proper taxation pay period after pay period. Due to the high cost, many businesses remain out of compliance and hope not to get audited. Many more businesses don't even know that they're out of compliance as they are not well versed in payroll tax law. So what's the solution? A real solution that's attainable by every business with a traveling associate. A phone app to make all of this complexity simple. The user would enter a few key pieces of information, including their state of residence, their regular work location, and their pay. GPS will be used to track employee movement across jurisdictions, triggering questions to determine if they're working there. This user-entered information, along with the GPS-tracked work location, will be cross-referenced with the reciprocal agreements and the de minimis standards. This will be used to alert employees when they have become liable for tax in a jurisdiction or when they have any potential liability. And they'll be advised of any action that they must take to avoid liability, such as submitting a tax form claiming residency in order to have a reciprocity agreement extended to them. Each pay period, a report will be sent to the employer detailing all of their employees that worked in multiple jurisdictions. This report will show the tax distribution as well as the taxable wages for each jurisdiction and any required tax forms. Links to the tax forms will be available and can be sent and tracked through the app. Additionally, notations will be included for any locations where the employee worked but had not yet surpassed any minimum thresholds to require tax withholding, and the employee will also receive a report detailing the same information on an individual level. A web browser application will also be available, so employers will have access for data entry and reporting on their desktops. Individuals can also use the app to double-check that their employers are taxing them correctly. Employees and employers can have peace of mind that they are paying the proper tax, making them less likely to be audited and assessed penalties and interest. And states will see an increase in their non-resident tax revenue and a decrease in expenditures on non-resident withholding audits. Thank you so much for taking the time to be here with me today, and may you always find yourself in compliance.